Okay, yet another way to prove that active investing underperforms passive investing regardless of the time period. It always underperforms passive investing. This is based on simple arithmetic and you can't get around it. Okay, so we're going to do the barrel representation. Okay, so this barrel represents all the money of all participants invested in the market. If the market goes up, the barrel expands. If the market goes down, the barrel contracts. If the market goes up or down by 7%, the barrel expands or contracts by 7%. Now the spigot represents the cost of investing. So this, even though it's a pretty poor diagram of a spigot, you have to use your imagination here. This is the flow of cost coming out of the barrel. Okay, so let's look at a few things here. Let's call the market the S&P TSX 60, and let's look at the iShares S&P TSX 60 ETF. Okay, so here is the BlackRock iShares S&P TSX 60 Index ETF. Okay, Royal Bank of Canada, represents 7.88% in the S&P TSX 60. This is its market capitalization weight. So we can learn a few things here. If we go to this, we see that Royal Bank of Canada has a market cap of $150 billion. So the number of shares outstanding times the current price per share equals $150 billion. Now this becomes relevant because I want to show you a few things. Let's go back. Royal Bank has a value of $150 billion and represents 7.88% of the S&P TSX 60 index. That's what I just showed you. Okay, so divide 150 by 0.0788, and we have close to a $2 trillion market cap of the S&P TSX 60. So of these 60 companies, if you add up their value, you get to approximately $2 trillion. I think it's a little bit less, but it doesn't need to be exact for this example. So there's our barrel. Our barrel is all the investors in the S&P TSX 60. It could be professionals managing money of clients, and it could be people doing it on their own. The barrel is worth $2 trillion. Let's say the barrel goes up 10%. This barrel is worth $2.2 trillion then. Now we divide the barrel into two barrels. So $2 trillion total money in the market. We're dividing it into two. All the active participants in the market and all the passive participants in the market. Then we're going to say that total money that is managed passively is 25% of all money. That tells us we have $0.5 trillion in the passive barrel. Well, we can figure out what's in the active barrel. 0.5 minus 2 trillion equals 1.5 trillion. Simple arithmetic. Every participant is either a passive participant or an active participant. We know what the definition of a passive participant is. They hold every company in the market. That's number one. And number two is they hold these companies in their market capitalization weight. Now, let's say the market grows by 10%. Well, we know that the market grows from 2 to 2.2 trillion. The definition of a passive participant or a passive investor is they get the market return. The market grew by 10%, so this barrel grows by 10%. And we're trying to figure out what does the active barrel grow by. And the reason we're trying to figure this out is if you get all active managers in a room and you say, hey, all you active managers in this market, the S&P TSX 60, which one of you guys is going to outperform the market? And every single hand would go up. And if that hand didn't go up, why are you managing money? You must be managing money for clients, or if you're an active investor doing it on your own, you must believe you will outperform the market, or else you would be in the passive barrel. Okay, so at least half those hands in the air pre-cost are wrong. Okay, so we say the market goes up by 10%. This grows to 0.55 trillion. We know this. That's the definition of a passive investor. This grows to 2.2 trillion. It's the market. We know this. Well, what does this have to grow by? This has to grow to 1.65 trillion. This barrel plus this barrel must equal the amount of money in this barrel. Well, what is 1.65 trillion? It's 10%. So the obvious pre-cost conclusion from this is that the active barrel must grow or shrink at the market rate of return. So all you active participants with your hands in the air indicating that you will outperform, half of you put your hands down because you will underperform pre-cost. Then we look at the spigot. We know that, let's say this group has a cost factor of 10 basis points and this group has a cost factor of 100 basis points. We know that the cost to deliver active management is more expensive than the cost to deliver passive management. Okay, so we're saying 10 basis points and 100 basis points. These guys they grew pre-cost 10%. They get 9.9%. 10% minus 10 basis points equals 9.9%. This group grows their money pre-cost by 10%. Cost is 1 full percentage point. They grow their money after cost by 9%. It is obvious. There is no getting around this. Now that proves that pre-cost, the group of passive investors and the group of active investors as groups get the same rate of return. And after cost, the group of passive investors always outperforms the group of active investors. And that's all we need to know about that. Okay, thank you for watching. I hope that helps. Leave me a question and visit BYOFA.com if you want to see all this stuff in written form. Okay, thank you.